Well, joining us for more insight on this is Dr. X. N. Iraki, economist and associate professor at the University of Nairobi. Thank you so much for taking the time out to join us today. Let's get right to it. And now the forecast for the outcome of that meeting was for a rate hold, but we saw the central bank hiking the key lending rate by 50 basis points from 12.5 to 13%, near a 12-year high. What are your, just to get your initial thoughts on, in terms of what your expectations were?
That was surprising to all of us. We did not expect the interest rate to go high as it happened. But my hunch is when the central bank raised the rate to about 12% about 1 month ago, the main intention was to make sure that we stop the depreciation of the Kenyan shilling. And true, in the last 2 weeks or so, the Kenyan shilling has started appreciating. And maybe the central bank realized that if this policy framework, if this policy change is working, why don't we enhance it by raising the interest rates? But I can assure you that a lot of people who have taken loans from the banks, as individuals or corporations, are not very happy with that. So I think the central bank thought that why don't we deal with the weak sharing and then deal with the consequences, which happens to be more people defaulting on the loans, and probably from an economic perspective, where less people are going to borrow, consume, and to invest. So that might have a negative consequence on the economy.
Well, that was obviously a risk that the central bank was willing to take. But let's talk about the other reason why the central bank raised that rate, and that is inflation. Now, I knew that in January, Kenya's January inflation printed at 6.9%, and the central bank has a 2.5 to 7.5% inflation target. Talk to us about the efforts that have been taken so far in bringing down inflation. Are the monetary authorities on the right path? And do you see, are we seeing any impact on that rate coming down?
I don't think inflation was a very big factor in this country, although everybody is complaining that the cost of living has gone up. But if you look at the taxes that people are paying, that is probably taking a lot of money from their pockets. So in my opinion, I think the biggest factor was the depreciation of the shilling. Inflation is not such a big factor because people don't have enough money to spend. But if you look at inflation, if you look at the value of the shilling, they go together. So if the shilling becomes stronger, then by extension, then inflation will go down because we get a lot of imports which are denominated in the foreign currency. So the two are working together.
Now, according to the central bank governor, in a statement after that meeting, he did say that the Kenyan shilling has overshot the equilibrium rate, and he says that there's actually more room now to support the currency. Outside of the measures that have been taken so far, including raising the rates, what other efforts or what other monetary policy tools has the CBN used, the central bank used to support the shilling?
Well, that's quite a very probably a very surprising statement, because recently the central bank said that the shilling is going to be allowed to fight its own value. But so far, nobody has told us which is the exact value of the shilling against the dollar or whichever other currencies. So for him to say that the shilling has overshot its equilibrium, which you have not been told, it is not very clear. We need to know exactly what is the rate. But it seems that the government probably has beyond raising the interest rates. The other probably tools it has, which I hope will not use, would be probably try and buy dollars, so that if it buys dollars, if it has enough dollar assets, then that will put pressure on the shilling to probably make the shilling appreciate. I can assure you, if you're importing in this country, there's a very big issue about the cost of importation, particularly considering that most of our fuel oil is imported, or oil is imported, and it is dominated in the dollars.
Now, oftentimes central banks are often faced with that challenge of fighting inflation on the one hand and ensuring that they contribute to boosting growth in partnership with the fiscal authorities. But many of them, including Kenya and Nigeria also included, there's always that shall I say unintended consequence, as it were, in the case where businesses now find it more difficult to access credit and also have difficulty in repaying loans, now, which is some of the challenges, concerns that have been raised, I suppose, by yourself also and some other economists. But I'd like you to help us understand the scale, what this means for small businesses in Kenya. Where is when you think about the financial industry, where non-performing loans are right now, ratios, if you will, are the numbers at levels that are concerning, or are they at manageable levels by the central bank?
I think whether you look at, particularly when you look at the small and micro enterprises, the individuals who have borrowed from the banks, they are feeling the pinch. I was talking to one Kenyan resident who had borrowed money from the bank. And he told me that when the interest rates went up last time, because the central bank raised the rates, the bank called him. He was told you're supposed to finish your loan maybe in 6 months. Instead of you paying more money per month, what we are going to do is we are going to extend the repayment period. Maybe we are due 1 year or so. So that is one way the banks are managing the interest rates, so that you have longer period to pay, but you pay the same amount of money. But if you're going to borrow money for the first time, you're going to borrow money maybe to expand your business, pay your creditors, or do whatever you're doing with the money, then you really feel the pinch of this increased interest rate. And as the interest rate goes up, not only do we have less people borrowing money, but you have more people defaulting. And if you look at a lot of banks' results that came out recently, the amount of money that is being reserved for non-performing loans has gone up. So we hope that very soon we are going to have stabilized interest rates, that people can borrow money. People can borrow money either for investment or for consumption, and that is going to stimulate the economy.
Okay, let's talk about another development that everyone's keeping their eyes on, and that's an upcoming maturing Eurobond worth $2 billion in June this year. Now, the Kenyan authorities, led by, of course, the central bank governors, come out time and time again to reassure creditors, investors, that they will get their money come June this year. He's talked about that there's incoming funds from the IMF, perhaps also the World Bank, and so all the multilateral institutions. And just this morning, we also heard of a $500 million samurai bond that the country is hoping to raise in Japan, which will be issued in 2 phases. Could you shed some light, first of all, on this $2 billion maturing Eurobond in June? Will the government be able to repay that bond? And also, if you could also just share some insight on this samurai bond.
It's interesting because the president of Kenya last year came in public and said we are going to start paying the partial maturity of the Eurobond in December, but that does not seem to have happened. And the market cheered up when they said that we are going to pay the Eurobond, part of it, in December last year. So when now the government says they are going to make sure they don't default on the Eurobond, I think that's very good news, because if we default, we might be like other countries that are going to suffer with higher interest rates if we default on this. So the government is doing very well by reassuring us that we are not going to default on the boat. The market, I'm sure, is going to cheer on that. My only concern is that we seem to be borrowing some money so that we can repay the loan. And the problem is we are borrowing money to repay the Eurobond, and the interests have gone up. That's my biggest concern. So I think the government is putting concerted efforts, maybe to float the samurai board in Japan, the presence in Japan. So if we can get the money from the samurai board at a lower rate than the Eurobond, and we get the money from IMF and from other multilateral lenders at a lower rate, so that we can repay the Eurobond, to probably relieve the pressure. But I don't want to see Kenya defaulting on the Eurobond, because it will have unintended consequences, particularly on interest rates.
Let's also talk about going forward, investors' sentiment or investor confidence when it comes to bonds being floated. For instance, Kenya going to the Eurobond market now. How would you describe investors' confidence levels towards Kenya going forward?
That's more the reason why we need to make sure that you have paid the Eurobond, because if we repay the Eurobond, it will give very good confidence to investors that if Kenya borrows money from you, be paid on time, it will be paid as expected. So we must make sure that we don't default this. That is not just going to give confidence to foreign investors, but local investors. Because the government does not just borrow money from foreign investors, it also borrows money from local investors. And once their money can be paid on time, they will lend you money in the future, and the confidence of the economy will go up. And that's what we are looking for, so that the economy can be stimulated to grow faster, create jobs for you and me, and we have a more prosperous economy.
Give us a sense of Kenya's debt stockpile right now, both domestic and foreign, and also a sense of where the debt to service is, the debt to GDP ratio and debt to service, in terms of how much of the government's revenue, total revenue, is going to service in debt, both foreign and local.
The last time it was made public, we were told that about 7 out of 10 shillings, or 70% of the money collected from tax revenues, are going to pay debt. And that's why debt is such a big issue in this country and quite a number of other African countries. So the sooner we are able to pay that debt, we can borrow maybe at a lower rate and repay this debt, clear it. Or what the government has been doing in this country is to move from borrowing to raising taxes. But that has political consequences. Earlier we talked about inflation going up. People are saying that they are being taxed and they don't have the money. So the government needs to balance between borrowing and taxing Kenyans so that it can be able to pay for its expenditure. So that striking that balance with political implications is not easy. But that's why we put the government in power to do all those things. Hard tasks, but somebody has to do it, which happens to be the current government.
Right. How would you describe the synergy between the fiscal and monetary authorities in terms of how they've outlined their policies for the year and how they're both working in tandem to achieve growth and development at the same time?
Traditionally, the monetary policy is usually the easiest to work with. The central bank meets, the monetary policy committee. They say that they are going to raise the interest rates, or they are going to lower the interest rates. So the monetary policy is much easier to deal with. But when it comes to fiscal policy, raising taxes, there are always some headwinds. When it comes to borrowing, there are always some headwinds. And one other area that probably the government should focus on is reducing the expenditure. And if you reduce the expenditure, that has political consequences. Probably have to tell some people to go home, reduce some government jobs at the county and national level, and people will not be very happy about that. So I think the government is trying to use both, but I see the monetary policy as being more effective for now than fiscal policy because of political implications. But you must use both like a pair of scissors to make sure that the economy improves.
Right. We have less than 2 minutes now. How do Kenyans feel about the president's economic reforms, in getting the economy off the ground and out of the woods? And is there a sense of some kind of a timeline for when the economy could potentially be in the clear? I know that there's so many headwinds right now. Kenya is not alone. Across sub-Saharan Africa, there's high debt rates, inflation, the cost of living crisis, etc. We're all going through it together. But is there some kind of a timeline for when the Kenyan economy could potentially be in the clear?
That's a very hard question, because when this government was looking for votes, it said clearly that one of its core mandate would be to reverse the economy, make sure that the cost of living has gone down, the interest rates have gone down, there's economic growth, and people get jobs. But it was very different when the government came to power. The economic circumstances, both local and international, have not been very good. War in Ukraine, that has raised the price of oil. The interest rates have not gone down. So if you look at the political reality and the economic reality, they are very different. So the political power, the government said that in 6 months, things are going to change. They said about 1 year, things are going to change. So it's about 1.5 years since they got into power, and things have not changed. But the voices coming from the government seems to be saying that it will get worse before it gets good. So they are saying that maybe the suffering people are going through is a sign that things are going to change. What we cannot tell is when things are going to change. Every Kenyan, rich and poor, is looking forward to the day the economy is going to stabilize, interest rate will start going down, the exchange rate stabilizes, and the economic growth picks up. So I cannot give a timeline. But my hunch would say that maybe the next 1 year, if the government puts its foot down, we are going to start seeing changes. Already last week, we saw the shilling stabilizing, and we hope the other economic fundamentals are going to change for better.
Well, let's hope that happens sooner than later. Thank you so much, Dr. Esther Iraki, for talking to us today. We appreciate your time and that insight that you've shared with us today. That was Dr. Esther Iraki, economist and associate professor at the University of Nairobi.